Hey guys, welcome to chapter 12. Today we will discuss chapter 12, which is accounting for partnership using accounting principle 9 edition. This is by Wiley Plus. Wiley Plus, the publisher Wiggy Wagon, Kimmel, Tensor, Warren, and Novak. And there's quite a long chapter one. So let's start with this one. Okay, let's start with. There's a number of learning objectives, number 1 to 7, which is describe the characteristics of partnership in the business organizations, do an account, a formation in partnership, allocate the record profit for lost partners, prepare partnership financial statement, accounting advising for partners, accounting model for partners, account liquidation as well for partnership. So this is basically for partnership, okay? So partnership between, let's say I'm setting up a shop like a samosa shop. I want to, instead of by myself, I'm going to have another partner, let's say John, okay? So what is accounting for partnership? Partnership form an organization based on a characteristic, advantages and disadvantages. There's a partnership agreement, okay, between me and John, for example. The basic partnership accounting is it basically forming a partnership, dividing partnership for profit and loss statement, partnership for financial statement as well. So let's say my partnership with John is going to 50-50, so it's going to be 50-50 in terms of the agreement. As well as there's an emission of withdrawal partners, liquidation of partnership with or without capital deficiency, okay? And then describe the characteristics of partnership, form of business organization. Example, inside of this organization, here we're going to have associated individual, co-ownership of property, unlimited liability, mutual agency, and limited life and division of profit. That's the key part. There's quite a number of things that have disadvantage. The most disadvantage for partnership actually is unlimited liability. This is what I don't like. Okay, if my partnership goes bankrupt, then we're going to have trouble because you're going to go after my personal assets. Okay. So there's an associate individual, usually based on a written agreement. There's a legal and accounting entity, but not tax. Okay, because co-ownership of property are jointly owned by partners. So I say 50-50. My samosa shop is 50-50. Me and John, excuse me. The division profit also is going to be divided by 50-50. That's the agreement, unless it is otherwise specified differently, let's say 60-40 or 25-75. So most of the time, partners say 50-50. But it doesn't have to be, okay? It doesn't have to be. You can do your partnership according to whatever you like. Limited partnership ends when there is a change of ownership as well. When my partner John decided to sell his stake to somebody else, then my partnership with John will be ended. So let's say John just sell it to Jane, so my partner will become Jane instead of John. New owner partnership can be formed to continue the business as well. Okay, there's a mutual agency. Each partner act behind a partnership and has an unlimited liability. That's the key part. Each partner is liable for all partnership liabilities. There's special type of partnership to limit liability, which is LP, which is limited partnership, LP, or limited liability partnership, LP. Okay, let's look at the characteristics of this partnership. Advantages: combined scale of resources of two more individuals. Okay, is easily formed, has few government regulation and restraint than corporations, allow for easier decision making. Okay, disadvantages has the following aspects such as mutual agency, limited life, and unlimited liability. Okay, in terms of contract agreement between two more parties, formal parties contain basic information like name and main location of the firm. For example, my samosa shop, I'm going to call that Maple Samosa Shop. Okay, the location will be in Burlington. The purpose of the business will be in the food business industry. Date of inception, let's say 1st of July. Okay, that's an example of the basic informations. And then specify your partnership partners. For example, name and common condition of partner. For example, everybody gonna contribute $10,000. So everybody gonna put $10,000 on that samosa shop. And then there's the right and duties of partners, and then there's a basis for operating for profit and loss. There's also procedures in terms of admission, withdrawal, as well as the death and resolving dispute and liquidation of partnership. So there's always procedures, and we call it as SOP, standard operating procedures, for these things: admissions, withdrawal, death, resolving dispute, liquidation of partnership. Let's say there's a disagreement between me and John, then the partnership can be liquidated or can be sold to another third party. For example, there's an SOP, standard operating procedures, for everything that is in the partners. Okay, make sure that is written down. And then learning objective number 2, account for the formation of partnership. Now, there's a basic partnership accounting, SPVs versus IFRS. Okay, many partnerships are private and therefore follow SPV. So most of them is following the SPV standard. But limited partnerships are often public enterprise and therefore follow IFRS. Anything that follow public enterprise, we're going to have IFRS. This is, IFRS I'm much more familiar with because, I've been involved with a number of I've been involved about 3 years, more than 3 years, 3 years, I think almost 5 years. 1 year with Intech, 2 years with Travels Canada, and then before that with BMO as well. So, when I was with Travels Canada and Intech, I'm doing IFRS 17 for the insurance IFRS project. Okay, that takes about 3 or 4 years. That project, that's a huge project, because each company has a different system. Let's say Intech has about over 8 to 9 system. We have to put in a different platform for all the system. Sometimes the system do not talk to each other. For example, policy system, billing system, claim system. So we have to pull all the data into a database platform. From that database platform, we're gonna pull all the information into one single database for the IFRS reporting system. Basic partnership accounting, forming of partnership. Partnership initial investment recorded at the fair value of an asset contributed at the date of the transfer into partnership. Value are signed agreed by all partners. After partnership is formed, accounting for transaction is similar to other types of business and organization. Okay. All right, let's the next one. Allocate the record profit and loss to partners. The dividing profit and loss. Partners are owners of partnership, not employees. A partner works for the partnership to earn profit as well as not a salary. So that's the key part: to make money, to earn profit, but not a salary. Okay, partnership profit is shared equally unless partnership agreement indicate otherwise. So mostly our partnerships are 50-50. If there is unless otherwise in a different there's a separate agreement. It's also called profit ratio or loss ratio. So if you make money, let's say the company Samosa Shop make 100,000, divided by each 50-50, each will receive 50,000. Okay, that's the key part. Each partnership also have recognized in terms of closing entries. So what are the typical ratios used in profit losses? Fixed ratios such as proportion 2:1, or percentage which is 67%, or fractions 2:3, and ratio based on the capital balances at the beginning or the end of the year and average capital balances during the year. Salary at the interest allowance to partners remaining to a fixed ratio. So that is the standard ratio that being used. There's also salary, interest, and allowance allocated at the first even greater than profit or in partnership incurred loss for the year. Okay. And then are not expenses at the partners only used to divide profit or loss among the partners and are not distributed of cash. Drawing of partners are distribution. Partner are either employees or creditors. Okay, those are the detail. In terms of forecasting of the partnership, there's a closed revenue of account to income summary. There's a closed expense to account summary to income summary. There's closed income summary to partners capital account. If there's a profit, the income summary debit to total profit and credit each partner capital account to their share profit. If there's a loss, it's debit to each partner capital account to the loss, and then credit income summary to the loss. Okay, so we're gonna close each partner drawing account to their respective capital account. So that is the key part in terms of partnership. In terms of preparing financial statement, objective number 4, we're gonna look here in terms of partnership financial statements such as partners equity, such as statement of partners equity here, the Kings and Lee example capital here each other. This is a typical example of the capital statement of partners equity. Okay, 27,000, 64,000 total. Okay, the capital for King 28,000, capital for Lee 24,000, total 50,000. Investment 2,000, profit is here 2,300, here's 9,700. There's a drawing here 7,000, 5,000. So there is a key in terms of capital there, showing up the detail. Okay, capital balances each here for the Kingsley. So you got total liabilities here 115,000, King capital 35,300. This is 28,700. So this is not, look like this is not 50-50, guys. Okay, so you see the difference there. Okay, right, the number is different, so King has higher percentage. Okay, so you can see here. Right, look at the next one, a confirmation of the partners. There's a cost for religious distortion of the existing partnership at the beginning of new partnership. A new partner may be admitted either by purchasing the interest of one or more existing partners, affect only the capital accounts of the partners who are parties to the transactions. In terms of inventing asset in partnership, increase both the net asset as well as total capital of the partnership. Admission of partner, purchase of partners' interest, a personal transaction between one or more existing partners of the new partners, consideration in exchange of personal property of the partners involved and not a property of the partnership. In any partnership, only transfer of the partnership is recorded. Okay, only transfer of partnership is recorded. What is it? Existing partner equity is decreased by the amount of equity given by the new partner. The new partner equity is increased by the same amount. So let's say my partner John has 50%. He sell it to Jane, so he's going to decrease by 50%. Jane is going to come in as 50%. Let's say if he have 40, the same story. He's going to decrease by 40, and Jane will come in increase by 40. Okay, that's the key part. Okay, so it's equal percentage. In terms of transaction between new partner and partnership receive asset from new partner in exchange for interest in the partnership. Both net asset and total partner's equity of the partners will increase. Complication occur when new partner's investment differ from capital equity acquired. The difference is considered a bonus either to the existing old partners or to the new partners. Okay, and then bonus to all partners may be necessary. There's a fair value. Partnership asset may be greater than the carrying value. There's also goodwill exists that has not been recorded. So you have to make sure, guys, there's a goodwill in every transactions, okay? Because if you have 100,000, you have been in the business for over 20 years, so there's a goodwill there involved. Okay, the goodwill can be decided among the partners or maybe a third party valuation. Okay, bonus to all partners occur when new partners greater than capital account credit on the date of the emission. The amount of bonus is the differences. Okay, let's say look at the next chapter. Bonus to new partner may be necessary if the new has resources or attribution to the partners who want cash or expertise. Okay, that must happen all the time when there's an expertise involved. Somebody has a subject matter expert on certain area. For example, since it's the samosa shop, my partners John may be an expert in making Hakka style samosa, for example. Okay, and then bonus to new partners when the new partner investment is less than capital account credit on the date of admission to partnership. Okay, amount of bonus equal to the differences. So, in terms of determining the amount of bonus, so you need to determine the total capital of partnership equal to the capital of all partnership plus the new partner investment. For example, how much it is, then you have to decide decide the capital first plus the new investment partner. And then number two, determine the new capital credit. How is it? Total capital determined above times new partners ownership and interest. And number three, determine the amount of the bonus, which is equal to new partner investment plus minus new partner's capital credit. If the investment is greater than capital credit, bonus to all partners. If the investment less than capital credit, bonus to new partners. Then allocate the bonus to from all partners based on profit or loss of all partners. Example, admission, capital balance 120,000, but 72,000, Huang is 48,000, so total 120. All partners 60-40, scenario time. So this is the key part. This is the scenario given to you. For 60%, Huang has 40%. Trend, purchase 25% of shares. Scenario 1, 80,000. Scenario 2 is 20,000. This is based on scenario 1 and scenario 2. So how are you going to go handle this scenario? Scenario 1. Capital current new partnership will be 120 plus 80,000, which is you got 200,000. And then 200,000, number 2, counting minus 200,000 times 25%, which is 50,000. The amount ratio to all partners will be 80,000 minus 50,000, which is here. So you got 30,000. The allocation will be 30,000 times 60%, 18,000. To Huang, 30,000 times 40%, which is 12,000. So this is the logic for the scenario. Okay, guys? Remember, this is given to you before. This is the first logic here. This is the first logical question. You got 120,000, 60, 40. The first scenario is 80,000. The second scenario, 20,000. 10 versus 35,000. So you're going to go back here. 120 plus 80, you got 200,000. First step. Second step, 200,000 multiplied by 25, you got 50,000. The amount of bonus will be 80,000 minus 50, you got 30,000. Then number 4, the last part, 30 times 60 for part is 18,000, and then 30,000 times 40%, which is 12,000 for Huang. So based on the proportion or percentage. That is for scenario 1. Now look at the scenario 2. It's the same story. You're going to add 120 times 20, 140. 140, step number 2, 140 times 25%, which is 35,000. Once you get 35,000, you got number 3 here, bonus. 20,000 minus 35%, you got 15,000. So our allocation bonus will be 15,000 times 60, 9,000, 15,000, 40, 6,000. So this is for number 2 scenario. Okay, that's the logic. So you're going to follow the step logic when you have this kind of partnership. Okay, calculation in terms of bonus. Okay, that's the scenario number 2. Then look at the objective number 6, withdrawal of a partners. What is a withdrawal of partners? There is a voluntary withdrawal when partners sell the equity in the firm, and inventory withdrawal when partner reaches mandatory retirement age, die, or is expelled. Withdrawal may be accomplished by payment from the remaining partners' personal asset and effect on partnership capital account. Payment from partnership asset can decrease both total net asset or total capital of the partnership. Okay. Withdrawal partners, payment from partners' personal asset. Transaction between partners, payment is from remaining partners' personal asset, and partnership assets are not involved, and total capital of partners does not change. Okay. And then look at the next one. Withdrawal partners payment from partners' personal asset continue if partnership only transfer of the partnership interest is recorded. Departing partner equity is eliminated. The remaining partners' equity increased by the same amount. Amount is split between the remaining parties on the same basis as they paid departing party. Withdrawal partners, payment from partnership asset, transaction between withdrawing partners and partnership. Partnership pay asset in exchange for withdrawing partners, interest and the partnership. Both partnership of net asset and total partners, equity of the partners will decrease. Complication occur when amount paid differs from the withdrawing partners' capital balances. The difference is considered bonus either to the departing partner or the remaining partners. Okay? Bonus for withdrawing partner may be necessary. That's the fair value of partnership. Asset may be greater than the carrying amount. The goodwill, see, this is always, may exist that has not been recorded. Remaining partners wish to remove partner from the firm. Okay, bonus for the withdrawing partner occur when the payment of departure greater than the departing capital balances on the date of departure. So this is the key part. Bonus to withdrawing partner occur when payment to departing greater than the departing partner's capital balance on the date of departure. Amount of the bonus equal to the differences. In terms of bonus, remaining partner may be necessary when recorded assets are overvalued and partnership has a poor earning records. Partnership also wish to leave partnership. Bonus remaining occurs, partner occurs when payment to the departing partner less than, this is the key part, less than the departing partner capital balance on the departure date. The amount will be, of bonus will be the differences. That's the key part. Okay. And then withdrawal in terms of the thing amount of bonus. We're gonna look at this logic later. Okay. So this is this is the theoretical logic, and then we're gonna look at the mathematical logic, the calculation. One, determine the amount of bonus, the payment from the partnership, departing partner, plus the departing partner's capital balances. If payment greater than capital balance, bonus to the departing partner. If payment less than the capital balance, the bonus remaining to the partners. Number 2, allocate the payment remaining partners based on the profit and loss ratio. The amount allocated to each remaining partner equal to the bonus times profit and loss ratio for each partner. So we're going to look at this example of bonus calculation. Okay, this is, we have look at the theory. Now is the calculation, mathematical logic. Partner capital balance: Roman has 50,000, Sands is 30,000, Turk is 20,000. Partner ratio will be 3 to 1. Okay, 50, 3 to 1. Okay, Tech retires, which is this guy. This is the 20,000 guy. Tech retires and is paid. Scenario 1, 25,000. Scenario 2, 16,000. So you get here three partners: Roman, Sand, Tech. 50, 30, 20. This is the ratios. And Tech retires, the last one, the lowest one. Retires 25,000, scenario 2 is 16,000. So what is the logic for the amount of departing partners? 25,000 minus 20, so you got 5,000 here. Allocate payment will be 5,000, which is 3 divided by 5, 3,000. Roman 5,000, 2 times 5 is 2,000. That's how it goes. Okay, this is scenario 1. For scenario 2, amount of bonus partners, 16 minus 20,000, which is 4,000. You do the same thing. 3,5 divided 4 times 4,000 to Roman, which is you got 2,400, and to Sand you get 4,000 times 2 divided by 5, you got 1,600. Let me just get a sip of water to see the next logic. Alright guys, let's look at the after scenario 1 and scenario 2. So remember this, I mentioned to you the logic here in terms of calculation bonus. You got Roman, 5 Sand, and Turk. Turk is retired, so you get this is the ratio. The senior is 25,000, the second is 16,000. So to recap, the first one's 5,000 here, the difference, you got 3,000, 2,000 each divided. The second ratio is the same story. You're going to do the same logic. You get that this is the calculation. And learning number 7, in terms of liquidation partnership. When liquidation partners, the step liquidation of partners. For example, when I sell samosas, my store is not doing well, I have to liquidate. So when I have to liquidate, there's a certain step that you need to do. What are the certain steps? Okay, when if business is good, it's good. I don't have to liquidate. But when business is not good, then I have to liquidate to sell to cut my losses. Okay, that's the key part. You have to be able to cut your losses when the business is not good. So this is the step given to you in terms of partners, in terms of liquidation. Sell non-cash asset for cash and recognize any gain or loss in terms of realizations. And then number 2, allocate a gain from the sale or realization to partners' capital account based on their profit and loss and ratio. Okay. Number 3, pay partnership liability in cash, and then distribute remaining cash based on their capital balances, not for their profit and loss, based on the capital balances given in the partnership. Capital efficiency, if one or more, if there's no, this is the liquidation of partnership with no capital efficiency. Capital efficiency is one or more capital account is in debit balance. If there's no capital efficiency, remaining cash after all assets sold and liability paid distributed to partners. Distribution is based on the partners' capital balances. Since this is a final distribution of partners, all account will have zero balances afterwards. Capital efficiency may be caused by recurring losses, excessive drawing by one or more partners, losses from sale of assets during liquidations. Partners having capital efficiency immediately before finalization may or may not be able to pay deficiency from personal funds. This will affect the amount of funds available for distribution to other partners. In terms of partnership, also in terms of liquidation of partnership, payment of capital deficiency, partnership has legal enforceable claim against partner with capital deficiency. If one of my partners deficient, I have a claim. I can claim it. If partner pays deficiency to partnership, amount to repay is either to cash available for distribution. Total cash of repayment is divided to partners with credit balance on the capital account. So there's a claim for it. That's the key part. Okay, there's a claim in terms of deficiency to partnership. You can claim it. Okay, if partner does not pay deficiency to partnership, amount of deficiency is considered a loss. Loss is located between partners with credit balances. Let's say there's a loss. 10,000. So each partner will take 5,000 cut for other. If the other partner do not pay. Okay, allocation of loss will affect remaining partners, and the final or remaining case is to partner with credit balance in the capital account. This is the key part, okay, guys. There's a liability in the claim if there is a partner goes deficient. So that's the one of the drawback disadvantage of having a partnership like this because of the liability side. So that is basically conclude this chapter. This is owned by copyright John Wiley. I'm gonna put this in YouTube as well as in Edpuzzle, so you can use this as a base for the next chapter for your review. Okay, thank you. Bye bye.